Alright, so nowadays it seems that all everyone is talking about is
you're being charged more every time you get to a checkout or every time a bill lands on your doorstep.
every time we seem to go and buy something, it feels like it's gone up in price. Maybe it's at the petrol station, when doing a food shop. You can feel it month by month, and it doesn't help it's being broadcasted by the news almost every second. Now, you might fairly be worried, is this going to ruin my retirement? So in this video, I'm going to be talking about ways you can look to manage what might be now 9-10% inflation, so that it doesn't cause you to run out of money in retirement. The first thing you need to understand is that when the news is talking about inflation, is that the inflation you hear on the news may be based on very different figures. The Office for National Statistics measures three main indicators to measure inflation: retail price index, RPI, consumer price index, CPI, and consumer price index including owner-occupied housing costs, CPIH. The RPI, retail price index, is consistently the higher of the three because its measures include mortgage interest payments. Now, CPI, consumer price index, doesn't include housing costs, and CPIH is just CPI including owner-occupied housing costs. So you may hear different figures depending on what's quoted. But can you tell me what is missing about these headline figures? It's that they have limited relevance to your own personal situation. That's why when times get tough with high inflation, we do have to rely on one of the core components of personal finance, understanding your expenditure. And once we have this, we can have a decent stab at your personal inflation number, which is how relevant these headline figures are to you. Because averages across the nation won't have a lot of relevance to you. If 60% of your expenditure is, for example, Critical Oats protein porridge, then a 10% increase in the pricing is devastating. However, if you live in a very sad world where you say eat cooked ham loose 100 grams, then that's actually dropped in price by 10%. Goddamn cost of living crisis. So I've assumed you've already done a budget, but if you haven't, this is really a time to get a handle on what your expenditure is. Because as the old phrase says, what gets measured gets managed. Now, I've included in the description 2 personal inflation calculators, so you can actually break down your own expenditure to give you a decent-ish indication of what you're working with. I used the ONS one and the Rathbones one. They both came up roughly the same figure. The ONS one I think I preferred because it came up and actually told me, right, here is your increase, which was around 8-9%. However, it also broke down certain areas and put it in a pounds and pence equivalent, which I think is really useful for budgeting. But the easiest and most accurate way to do it is if you did expenditure last year, just revise your expenditure details. There you can see where your main contributing sources of your expenditure are, and it can give you an interesting insight into, right, can I make improvements to maybe where I'm getting these things from, so I can maybe have a look at a cheaper way to do it, or potentially at least give you an idea of, right, here is the issue that I'm now dealing with. So once you've done that, you really could do with checking your inflation protection within your current assets. So what do I mean by this? Well, if you are at retirement, a big one is if you happen to have any pensions in payment. So you need to check what increases you're expecting to get. Now, under current legislation, the state pension is protected by the triple lock, which means it will increase the higher of CPI, average wage growth, or 2.5%. However, you might also have, for example, an annuity in payment, or maybe even a defined benefit pension, which could have some inflation increases. Typically, you might either have no increases, or you could potentially have an increase with inflation, or maybe even inflation capped at 5% or 2.5%. Again, check if it's RPI or CPI. The reason why is because, look, if you've got a pension which you know is going to increase now at 5% per year, and we've just calculated your personal inflation rate, and you were like mine around, say, 7-8%, then in at least understanding these two elements, you can understand that there is a 2 or 3% deficit there, not perhaps the 10% if you'd just taken the headlines for granted. Okay, so what's the next thing we can do? We need to make sure we're not leaving tax-free money on the table. So here are just a couple of tax tips which are surprisingly common for people to miss. So one of the first questions is, are you contributing to a money purchase pension? So that's one without a guarantee. It might be through your private pension or through your work. And the question is, do you know how they're applying tax relief? It could be the case that maybe they're doing salary sacrifice, where, as the name suggests, you just sacrifice part of your salary and that's paid into a pension. What's also called net pay, where the contribution is taken off before tax is applied. Or, and here's the crucial one, relief at source. This is where you make a contribution and then it's grossed up by 20%. So let's say you contribute £8, 20% tax relief is added, and the pension provider adds a tax relief, so they then get £10. Now, the big thing that a lot of people miss here is that for tax relief to apply to the higher or additional rate, so additional 20% or 25%, depending on whether you're a 40 or 45% taxpayer, you have to claim it through your self-assessment. In fact, apparently 8 in 10 higher rate taxpayers fail to claim relief through self-assessment, according to analysis by pension provider PensionBee. Now, that apparently, again, is over £810 million per year that goes unclaimed. And what's more, if you haven't actually done this in some time and you have been eligible by being a higher or additional rate taxpayer in the years, you can actually go back the last 4 years. So look, one of the easiest ways to beat inflation when it's rising is to reduce your tax bill if that is something that you haven't been taking advantage of. And in the spirit of that, the next one is, look, are you married or in a civil partnership? Then are you claiming marriage allowance, or are you able to? So for this to apply, one partner has to have a spare part of their personal allowance that they're not using. So they have to be earning a relatively low amount. Now, you can transfer £1,260 of that if your spouse or civil partner is not using that amount of their personal allowance. So the personal allowance is £12,570 this tax year. And the other spouse, if they are going to claim it, has to be a basic rate taxpayer. And it allows you to transfer that, as I mentioned, £1,260 to your husband, wife, or civil partner. Now, this can reduce their tax bill by £252 in the tax year. So again, if you haven't claimed it, this is an easy way to get a quick win. You can also backdate this from 2018 if you're eligible and haven't been claiming it. Okay, so what's the next thing we can do? Well, we can have a look at our investments. And I think what's crucial here is to remind ourselves of the long view. Now, as I'm going to mention in another video, equities are not an inflation hedge because they don't move in opposite directions to rising inflation. However, over the long run, looking back at all the history of equities across developed markets, they have beaten inflation over the long run. And I'll show you some graphics here. So the key argument here is, can we address the short-term pain by focusing on time horizon and discipline? We just have to understand that the ups and downs is totally a natural part of investments, that we have good times and we have bad times. Now, the reason why equities outperform inflation over the long run is, well, why wouldn't they? Companies at their very heart buy and sell things from real people, which reflect price increases. And it's those earnings which drive long-term returns. As shown here in a recent JP Morgan Guide to the Markets document, over the long run, equities have significantly outperformed inflation. We also have to try and avoid panic if it's at the detriment of our long-term goals. The amount a market goes up and down at different points in the year is not a particularly good guide of where the market will finish for that year. So that's not just me trying to put a positive spin on this, it's just trying to say declines are totally normal. This is the price of admission with investing. And whether you will be an investor who significantly underperforms their own investments will depend entirely on your own behavior. So the red point is the intra-year declines, so the low point of the investments over that particular year. And in the bar above it that's the final return. And as you can see, it is very common for there to be consistent ups and downs across the year. So in my view, it's important just to take a step back and realize what's within your control and what should be acted upon and what shouldn't be. And the final thing we can do is, look, if you're doing your own assumptions, stress test them. So this is where proper cash flow modeling and management comes in. Now, if you've got a financial planner, what they should be doing as part of the planning is looking at different environments, such as a higher inflation environment. The quote goes, all models are wrong, but some are useful, is true. But the reason why financial planning is an ongoing process, not just a one-off event, is that part of the plan is taking into account and considering different scenarios when things don't go to plan. Because life is always going to be variable and unpredictable. This should be done proactively and not reactively. So for example, as part of planning with my clients, one of the planning scenarios we'd look at is if inflation is higher than expected and if growth rates are lower than expected. In the same way that a training schedule is only a roadmap to achieving your goals, in real life planning and adapting to reality is where the true value lies. But finally, just a bit of a positive spin, which is bear in mind that higher inflation rates means that if you do, for example, have a mortgage, the real terms amount of the debt could well be eroded in a much larger way than expected. We just have to hope that house prices don't correct too much off the back of it as well. Now, the YouTube algorithm has told me wrapping up an episode over too long kills retention, so all I have to say to that is